And we are live. Good morning. Happy Friday. It is Friday, October 7th, 2016. Let's flex those muscles. Come on, let's get ready. Let's wake up. Let's get that blood pumping and flowing because we're all about pumping blood and flowing it or something like that. Speaking of Halloween and vampires and zombies, we were talking about zombies before we went live. I did my best zombie impression and Erica liked it. And that means something because Erica knows zombies.
It was impressive.
So this morning, I, among other things, woke up to a post from our friend Blake Oliver, who posted an article from a woman by the name of Ruth Whitman, who is apparently originally from the UK, moved here to the States to work in Silicon Valley. Actually, her husband got a job in Silicon Valley. And it looks like she's written some books about the pursuit of happiness and why the pursuit of happiness itself makes people unhappy. And this brought out my inner New Yorker. I was not happy with what she had to say. So I wrote a rebuttal post this morning. That's what I spent a good chunk of this morning doing. So go to SethDavid.com when you, not now, because of course now you should be here and paying attention. But you'll find my newest post is called The Hustle and the Pursuit of Happiness. And it's my take on what it means to be truly happy and how to get there. So, and I don't think, one of the short answers is, you know, she cites research. You can't research happiness. It's not quantifiable. It's spiritual in nature. And accordingly, and I make this point and I go on in the article on a bit of a rant, but it's self-diagnosed. Only I can decide if I'm happy or not. You can't tell me if I'm happy.
And you know if you're happy or not. I mean, exactly. You should.
Exactly. So I thought the whole article that this woman wrote was just such BS. And she looks like 2 books about the subject, about how our pursuit of happiness is making us all anxious people. And that's why we need pills. And I'm just like, wow. In my opinion, she's got it wrong on every possible level. And I let her have it in the article. You'll see, especially at the end, I told her to get the F out of this country if she hates us so much.
Wow, that's a pretty powerful statement.
It was. And I thought about revising it, and I said, no, I'm not going to edit myself. That's how I feel.
Must be channeling your inner Donald Trump.
What?
So you must be channeling your inner Donald.
Yeah, something. Well, I even said, before I said it, I prefaced this by saying, I'm going to be tough on you here because I was a New Yorker before I was a Californian. So, because she talks about Californians and how, you know, we all are. Anyway. That's that. Let's stay focused on the subject at hand, which is, of course, business valuation and analytics.
Can I interrupt you? I'm so sorry, Seth.
Please do.
Give a shout out to our friends that are in the way. Sarah Laidlaw, Deb Kilsheimer, and anyone else that's down in the Florida area, Florida, Georgia.
Sandra's one of the people I saw marked herself safe on Facebook. Yay!
Yay! We're so happy to see you here, Sandra.
My parents are actually in Delray Beach, Florida, and I love that my nearly 70-year-old parents use WhatsApp. So we have a family group in WhatsApp. So I messaged them yesterday saying, hey, are you guys okay? Do you need to evacuate or anything? And they're like, no, it looks like the storm's mostly going to pass us. And, you know, they're just getting some high winds and things. But at that time, they said the storm had already moved north of them, and that they were basically okay. But they had their shutters in and all this other stuff. You know, it's funny. People say to me that they would never want to live in California because of earthquake, but it seems to me that no matter where you go, there's something to be scared of, right? You know?
Absolutely.
Yep.
So just choose somewhere that's going to make you happy, right?
Yeah, but now the clowns are everywhere.
What's that?
The clowns are now everywhere.
They are. And soon those clowns are going to turn us all into zombies.
They're closing schools around here because they're getting threats from clowns.
I saw that article. That was hysterical. At first I thought it had to be a joke. But as I read more, I was like, no, this is serious. They were.
The clown was threatening to kill students and teachers or something. I don't know.
And the parents were upset because they didn't send the letter directly home to the parents. They put it in the hands of the children to take home. So, of course, now all the children are freaked out and scared of clowns.
That's crazy.
But clowns are scary. Clowns kind of freak me out a little.
I have a little granddaughter that's scared of clowns before all of this happened. I think Stephen King did it to her.
Well, and there's also a classic cult film called Killer Clowns from Outer Space. I actually did not go to my senior prom. Instead, I stayed home that night and watched that movie. The girl that I suppose I could have taken to the prom, but we had, I think, a much better time watching Killer Clowns from Outer Space. You have to see that movie. It's like the worst movie ever, but it's hysterical at the same time. And especially it's got to be hysterical now, watching a movie all these years later. You know how anytime you watch an older movie, like watch the first Star Wars, it seemed like they had the coolest special effects, but you look now and it almost seems cheesy compared to the effects we have today. Anyway, none of this has anything to do with business valuation or analytics, but it's still fun, and that's good. What do they call it? Banter. But yes, we're glad everybody, as far as I know, everybody is safe. So Adam says Adam loves KKFOS. He even has the acronym worked out. Still accounts for matter. So, I think Adam and I are we're probably like brothers in a former life or something, kindred spirits or something like that. Anyway, I have somebody on Facebook Messenger, Astrid, who says she's in listen-only mode driving. There is a Zoom app, but I'd prefer you didn't use the Zoom app with the camera while you're driving because I don't want to be responsible for the accident that you get in. So please don't do it. We've had a few people that were, it looked like, in their cars, but they admitted that they were not actually driving. They were parked. Wait, Astrid's writing a response. Okay. Hi, Astrid. She says, no. So, who wants to talk about business valuation and analytics? Anyone? Or we could just talk smack. I don't mind. I've had some serious ones several weeks running now. Maybe we're due for a lighthearted one. Maybe we'll do that next week. By the way, so last week we did the whole receipt tracking thing, and Damian Greathead from Receipt Bank reached out to me. Liked what he saw, and so I suggested that he could come on and give us more of a deep dive and demonstrate, you know, from the horse's mouth, so to speak. Not that I think Damian Greathead is a horse, but you get my meaning. So I'll probably have him come on soon and give us more of a deep dive, you know, because I only have limited experience with Receipt Bank, so I think it'd be helpful to have him come on there and do that for us. I see Sarah. Sarah is here, and she is in her car, evidently safe and sound for the time being. Thank God. Hi, Sarah. You're muted, but she's waving. I don't know if y'all can see her. She's in one.
I'm lost in Macon.
Okay, so you're safe. That's the main thing.
Yeah, but I'm at least away from the storm.
Good. Very good. All right, I am going to bring up a spreadsheet, of course, on my other screen before I begin sharing, so we can talk about business valuation and analytics and all that fun stuff. So let me preface this by, first of all, at this point, I've let all the viewers in that I can let in. Once I go into screen sharing mode, I'm not going to have a gauge on the viewers. So there comes Kevin, last gasper here. So if you end up here in viewer mode and I don't see you, I apologize. I'll do my best to check back, as I often do. A lot of talk has happened, I think, over the past couple of years, really, maybe even more than that, about becoming a firm of the future. The phrase firm of the future is sort of a phrase that I believe was coined essentially by Intuit. You know, and that's their kind of reference to us as bookkeeping and accounting professionals really making a move towards what the future looks like. And, you know, I remember years ago when Doug Sleater was constantly and frequently talking about how the role of the bookkeeper was going to change. It's not going to be eliminated. It's just going to look different. So, because in the past, what did a bookkeeper do? I actually looked up the definition of the word bookkeeper years ago because I was curious what the actual strict definition was. And I think I looked up the word bookkeeping, and it was defined as entering financial transactions, which, you know, I think soon, if not now, that definition will be rewritten because nobody's really entering financial transactions anymore. Isn't that right? I mean, we're really, you know, everything's being downloaded electronically through bank feeds. Or last week, we looked at a whole bunch of solutions that could be used to capture a physical receipt and then push that receipt into your accounting software. So we saw firsthand an example last week of a tool that actually takes us away from that manual data entry. And at this point, I think most, if not all of us here especially, would agree that if anybody's actually sitting there manually entering transactions, they're already way behind the times, right?
Well, the goal is to not manually enter them.
Right.
We need to watch to make sure that they are entered and then only manually enter the ones that need to be entered.
Right. If, for example, a transaction was done by cash, right? So if somebody says, "Hey, I paid cash for office supplies," then we got to book that manually. Even then, not necessarily, because I can get the receipt, snap it, and very minimal data entry. But you're right, Gina. And where I was going is that we're not manually entering data, but we still do need to babysit and massage that data and make sure it gets coded correctly, right?
Journal entries too.
Come again?
Journal entries for corrections.
Right. So journal entries for the, and typically that has been seen as something that's part of the role of the accountant more than the bookkeeper, right? Or the CPA or the enrolled agent who's going to prepare the journal entries in order to get the books ready for tax prep, right? That's kind of where we start defining what's the role of a bookkeeper versus what's the role of the accountant or the CPA, or if it's a larger company, the controller or the CFO, who's somewhere in between the two, right? In fact, on the consulting side, the niche that I've sort of carved for myself is that of kind of an outsourced CFO who sits perfectly in between the bookkeeper and the CPA who needs to do the taxes. And I can very well speak both of their languages and kind of connect the dots between the two. And that's how I made a lot of money in the consulting world, is by filling that exact gap. And that exact gap is a very wide one in many instances, especially with small business, where they can't really afford to hire their own controller or CFO, and they have to work with a CPA or an enrolled agent to get their taxes done. And oftentimes, the business owner and the tax professional really don't speak the same language, and the business owners just sort of take their word on things, when somebody like any one of us sitting here can actually sit in between and do the translation and make sure that the business owner really does understand, because now they're going to see a dramatic increase in the value of what we do, right? Because all of a sudden they're going to understand things that they couldn't understand before, and that frankly, oftentimes the CPA or the enrolled agent, or more generally the tax professional, doesn't have the time or even the patience really to explain all that. They just want to get the tax returns done. And I think, and I've said this and I'll continue to say this, I think that approach towards this is a mistake. I think that those people would be well advised to change their way of thinking and take the time and find a way to grow the patience to start explaining things a little better, because the business owners are going to see much greater value in what they do if they take the time to do that. And when you start doing that, you can increase your rates, charge more money, work on less clients, and you make more money doing less work. I think that's the name of the game. I think it's probably fair to say that sort of holy grail of almost all businesses, we want to do less work and make more money somehow. And that almost seems, what's the word? It almost seems counterintuitive. How can you make more money and do less work? And the answer is getting smarter, getting more efficient, and using the tools that are out there. And now we come to, what does it really mean to be a firm of the future? What does it look like when I want to provide that strategic guidance, which is really what I'm getting at? Right? The CPA or the enrolled agent who's just completed the tax return for their client has just had a look under the hood. They've had to, in order to satisfy themselves about the numbers they're putting on that tax return. Why not spend the extra hour per client and go an extra 15 miles with it, so to speak, and give an analysis to the client about what you've just seen now that you've had a look under the hood? Right? Because that's what the clients want. The biggest complaint I see from clients about their tax professionals is, all I get at the end of the year or the end of the day or whenever it is a bill for their services and a voucher for my tax payments, right? And they feel like, okay, what else? You have all this knowledge and information. Please impart that to me, right? And that's where I think a lot of clients get frustrated. And I had linked recently to a site. It's one of these I don't even know how to describe it, but it's a site where you can post a question and people can post their responses in little blurbs around the site. I'll dig up the link if I have time later, or after the fact, I'll send it all to you. But it basically asks the question, where do you feel your accounting professional could do better? That was the essential question. And one of the most common responses that I saw here was that what it all boiled down to really was, I want more strategic guidance. I want my accountant to tell me how I can do better, how I can make more money, right? And we have the knowledge and the experience and access to the numbers and an understanding of what those numbers mean, which can enable us to provide that level of service to the clients, which can increase our value tenfold in their eyes. So, one of the things that has somewhat frustrated me over the last few years is everybody's talking about it and how you need to become a firm of the future. But not one single person that I've seen, in my opinion, has done anywhere near an effective job of explaining how to go about doing that. What exactly does that look like? I mean, we have a rough idea, of course. Yes, we can analyze the numbers. We can review the balance sheet and the P&L with clients. That's nothing new. But how can we take this further, especially with the role of the bookkeeper changing as it has? then what can the bookkeeper do because they're not entering data? And presumably, if we're using the apps in the ecosystem, we've freed up more time. That's why we're going to flat rate pricing models rather than billing by the hour, because we lose if we bill by the hour when we get more efficient. I hope everybody gets that by now. Right?
So Seth, that is such a subjective, because each client is at a different level technology-wise. I mean, there are clients that refuse to grow, and then there are those that actually see the vision and want to leap into the future.
Mm-hmm. And we as professionals have a decision to make there. Right? I can either choose to work with those clients who refuse to move forward with the technology, and I can provide a great service to them if that's what I want to choose. Or, my personal decision along those lines is I don't want, if a client wants to work with me, they need to be prepared to come into the future with me, and they need to grow.
Yeah, but what I'm saying, there are different steps for different levels. If you have someone that is still handwriting everything, you've got to get them used to working digitally instead of picking up a file and looking at it and then entering.
Sure.
You have to get them used to saving to PDF as opposed to printing. And then there's the newer, younger generation is already there. They're already used to dealing in a digital world. So you've got to step it up a different level and say, okay, here's the apps that can work with you. So
Sure.
There's a broad range there.
Without a doubt. And obviously each client needs to be evaluated individually so that you can outline a plan of action for how to onboard that client and get them to where you want to get them to so that you can provide the best possible value to them. I mean, there's no question about that. And my approach with the less tech-savvy client is going to be very different than the approach with the one who's more tech-savvy. No question about that. But my goal still, I think, has to be the same at the end of the day, which is to take that less tech-savvy client and train them and teach them and help them grow to a place where, because ultimately, my goal is to serve the client's best interests. And, that can be subjective, right? What is in the client's best interest? But so here comes my opinion. My opinion is that the client's best interest is to get them up and running with the most efficient technology possible. Now, that may be a longer road to get there for some clients because, like you said, Gina, some are closer to that point than others. But the point is to work with them and meet them on their level and get them there, right? Because
educate them, entice them, give them a little bit of an example of what can happen if they do move in that direction.
Sure. I mean, to a large extent, what I will do, in my own case, when I'm taking on a client that's less tech savvy, first of all, a lot of them coming in my door, I think, because of the way that most of them find me in particular, they're already kind of coming in the door expecting that from me. So, again, I'm a little different. We're all a little different. But my approach with them is ultimately going to be the same, which is I'm going to go to that less tech-savvy client and say, okay, here's the deal. Here's how I work. I will get you into the future. I will get you up and running with, QuickBooks Online, with all the apps that we need to process things efficiently. I'll have that conversation with them, and I review their operations with them, usually on the first couple of calls. And if they tell me, oh, I'm printing checks, then my first answer to that is, okay, we need to stop that. How much time are you spending printing checks? And you have that conversation. And I say, I can make this not only more efficient, but 1,000 times more secure. And I'll explain to them why printing checks is an excruciating vulnerability in the security and the safety of your assets, your primary asset, which is cash. Right? We need to protect that, and we need to get things more efficient. And I usually can, end that discussion pretty quickly by saying to them something like, hey, I'm assuming there's other things you'd rather be doing than printing checks, things that would probably contribute much more directly into your margins. Right? Something that would increase your profitability. Really, if I took away your need to spend any time printing checks, that would make you more profitable. Fair to say? And usually they're going to say, yeah, that's fair to say. And I say, great, let's start putting a plan together to get you into something like bill.com or get you set up on autopay with your online bill pay at your bank. If cash flow allows for it, then you can often just go set up autopay with each of your vendors, and then everything is just taken out automatically as soon as the bill comes due. Then you have maybe a handful of outliers because, and I keep using the same example, but let's say your IT company, doesn't have a place where you can log in and set up autopay. So fine, your IT company, you set them up with online bill pay, and when that bill comes, you just go in and manually log the payment. If I have to do that for 4 or 5 vendors a month, I'm okay with that. And I'd rather do that than, frankly, go to the expense of a bill.com at that point. Now, if cash flow doesn't allow for me to just pay bills when they get cut, then we need something like Bill.com, because that'll help me manage the cash flow a little better and decide when to pay something and still have one easy place where I'm not printing checks. So I have the security and I also have the efficiency of being able to pay a bill in a single tap on my mobile device. You know, it may be some roads there will be longer than others, right? But at the end of the day, my goal is the same, which is to get the client to that place where I can provide the most value I can ever provide anyone, which is where we've substantially automated the accounting and bookkeeping as much as it can be, so that my focus then becomes on the strategic advice. And that comes down to the analytics, which is what I really wanted to spend most of today talking about and showing you. So with that, I'm going to share my screen. And actually, I think I shared the wrong screen. Let me try that again.
We love seeing your boat.
My boat is nice. Too bad it's not mine. So I saw the chat lighting up, so let me check that real quick. Let's see. Katrina says, I had just had a client that paid a vendor bill via Bill.com, and the vendor's check payment was stolen in cash. That's interesting. But that's because they didn't do the e-pay, right? So again, when you have Bill.com producing a check on your behalf, it's not that much different. And because here's the thing, what Bill.com does is every day, any check that's been authorized to be paid gets uploaded to the bank. So that problem was not really with Bill.com. It was with the bank who let them cash the check, number one. It should have been suspicious, and it should have been caught on that side of it, right? Bill.com has the utmost security on these things, and the bank, the maker of that check, you know, the bank whose account on which that check was drawn, they will not honor a check unless they've already checked against the list that Bill.com has uploaded to them for verification. So you got to do e-pay. First of all, they'll get paid faster. Second of all, that's where you get it the most secure, because nobody can steal an e-payment and put it in their own account, right? So and you know, again, therein lies the problem, is that the check was cashed at a convenience market, and that's a problem because nobody's checking stuff, right? And now the vendor gets it. So unfortunately, sometimes it's an expensive lesson learned that we have to learn in order to understand the importance of doing these things. Because a lot of times we experience that inertia, especially with those less tech-savvy clients that Gina was talking about. That's where you're going to see the most inertia, because their first reaction in many cases, from what I've experienced, is going to be something like, well, what I'm doing already is working for me. I've been doing it for years, right? That's the most common argument we get is, oh, I've been doing it this way for years. That doesn't mean it's the best way. It means you got complacent and comfortable doing something the same way. Doesn't make it the best by any means. So, you know, again, the goal really has to be, and here's the other thing from the strategic standpoint, as the advisor who's setting up Bill.com as the service for the client, you know, again, I'm going to include the cost of Bill.com in my monthly fee. And then what I need to do in order to scale it is get as many people as possible on ePay and practically insist on it, because the ePay costs less than the check with Bill.com. So the more I can do that, the cheaper Bill.com gets for me, and the more profitable I become in my monthly fee, because I'm charging that flat monthly fee. And the goal there is to scale the cost down as much as possible on these things. So all of this is to say that I'm going to show you quickly, before I get into the actual spreadsheet and the analytics and that kind of thing, you know, all of this, what we're talking about this morning, is inspired by a course that I am one lesson away from completing, which will be live on the site probably by end of day today, if not by Monday for sure at the latest, which is here. It's How to Evaluate a Company, Analytics and Business Valuation. And this is one of my answers to that question of how do I become that strategic advisor? How do I become a firm of the future? It's doing the analytics. It's taking the information that the client has spent money with us and that we've spent time on compiling, and now starting to use that information in a way that's intelligent, useful, and strategic. Right? So we're looking at first ratios, right? And then we'll talk about valuation. So I have a spreadsheet. This is kind of and Dennis has seen this, I know, because Dennis has been sort of on this journey with me for many, many years. And years ago, when I originally created this in Excel, I remember Dennis had gotten his hands on it and actually sent me links to some books that kind of take what I did here, you know, much further. And so Dennis, if you don't mind putting some of those books in the chat for everyone, that would be great. Because Dennis has a lot of familiarity with what I'm going to be talking about here. And what we're talking about is ratios. And the ratios, the way I've outlined this, are divided up into a few different categories. So let me go to a different tab on this sheet. And this is available, of course, to those who've taken the course or who will take the course. Let's go here. Let's see, ratio comparisons for a small company. So I actually took a presentation that I attended years ago from a Wall Street fund manager who talked about how he uses this kind of fundamental analysis to evaluate companies and whether or not he wants to invest his portfolio's funds into those companies. And so he gave us the PowerPoint, which had all his tables and the ratios that he used. And what I did was I kind of took out all the stuff that really only applied to public companies, because I said, I want to kind of chisel this down to something that would work in the environment of a small business. And so what I wound up with is what you're seeing in front of you here. So we have growth rates, which I actually didn't really talk about in the course because I feel like it's pretty straightforward. The first thing to analyze is your revenue growth. Right? And year over year, have your revenues grown? Have they increased? And if so, by what percentage? Right? Over here, I've got it laid out in terms of a monthly analysis, but obviously, and you all know this because you're all accounting and bookkeeping professionals, I think, for the most part, then you know that you can easily run a report in QuickBooks or Xero or whatever accounting software you use. And the bottom line at this stage is if your accounting software can't run these kind of reports, then you need to find new accounting software, no question. Because if it can't do this basic reporting stuff, then that's a bigger problem. But I'm pretty sure whatever any of us are using can do this. You can run a P&L and a balance sheet, and you can total them by month or year or quarter. People are asking for me to enlarge the screen. Let me switch it over to my smaller screen. I've got it on a high-res screen, so from your standpoint, it looks small. You also do have, or should have, a full screen option, which I think would make it larger for you. But nonetheless, this should look much better, I think, to everyone. And if somebody wants to unmute and confirm, hopefully that's better.
Yeah, it's much better, Seth.
Okay, perfect. All right, so now I know when I do these, I need to share it on my smaller screen. So, looking at the growth rates, I didn't bother to really get into this in the course because I hope it's very straightforward. You compare a particular period's revenues with a particular prior period, and based on that, it's pretty easy to determine if we're looking at improvement or not, right? All right, so Alexa said full screen didn't help. Okay, but hopefully it's good now, I guess. So, the bottom line is I want revenues to increase year over year. But the problem is I can't stop there with my analysis. I have to know why they're increasing, right? And I have to know what else is increasing or not increasing along with that. Because if my revenues go up and my expenses go up at the exact same rate, then probably I'm investing more resources to make only the same amount of money. Right? There's a good indication that that's what's happening if my revenues and expenses are growing at the same rate. The idea, of course, is to become more profitable over time, which means I need my revenues to grow faster than my expenses. I need my revenues to increase at a greater rate than my cost of goods sold. So it's really important to look at the whole picture. And oftentimes when I've worked with clients, my favorite example is I had this one client, so a real small business, and didn't really even know about the balance sheet. Only ever wanted to look at the profit and loss. Wanted to see how much money she made. And I started trying to introduce her to the balance sheet, and she very quickly got overwhelmed and just dismissed it and said, I don't need the balance sheet. I just need the P&L. Until a couple years later when she got audited. And she was just, sole proprietor, didn't have a corporation or LLC. And I think Dennis will probably agree with me when I say that your chances of audit are substantially decreased when you have a legal entity like a corporation or an LLC. I think your chances of being audited as a sole proprietor are greatly increased when all you are is a sole proprietor. Dennis, would you say that's fair to say?
They are targeting the sole proprietors for the tax gap, which is basically what the IRS calculates should have been paid versus what's been paid. Although with S-Corps, the thing you have to be worried about is reasonable compensation. Mm-hmm. But as a general rule, they look at the sole props because they tend to mix personal and business expenses, overstate their expenses, understate their income, that kind of stuff.
Right. And I think what that really underscores is that the general assumption, whether it's true or not, doesn't matter. What matters is that it's an assumption that the IRS is making here, is that sole proprietors are less experienced and therefore more prone to making mistakes that will lead to underpayment of taxes. Right? So that's what it comes down to. The bottom line is, as advisors, we should advise our clients that it's important sooner rather than later to set up the appropriate legal entity. Which one is appropriate is a whole different conversation. And there's some great articles on that, by the way, that Desiree Anderson has published on Between Wall and Main. So go to her column on Between Wall and Main, and you can read about how to learn which entities are the right ones for the right kind of business. And depending where you are and on a lot of other factors, it can make a difference. So back to the ratio analysis, the growth rates are fairly straightforward. We want them increasing, but again, we can't stop there. We need to know what else is increasing or decreasing along with that. So the ones that I do cover are our financial strength ratios, and then we get into management effectiveness, and then profitability, and then efficiency. Right? So these are the major areas of ratios that I'm covering. Again, it's financial strength, management effectiveness, profitability, and efficiency. And we'll get into each of these ratios in a minute and kind of dig in a little deeper on, what they mean and how they're calculated and so on and so forth. So, the financial strength, as the term suggests, the spreadsheet, sorry, is only available to people who've taken the course. Sorry. But I have to retain the value of my course for the people who've paid for it. But it's here, and you're welcome to sorry, I'm a teaser. Laura, you have access to it. You're signed up. But, and of course you can look at this and figure it out and Google the ratios. And that's where I got a lot of the information that I'm going to show you here in a minute also. And I'll tell you what, if you email me, since you're on this, if you're signed up 25 and up, then yes, you'll have access to this for sure. So I don't want to get too far sidetracked on that stuff though. I want to stay focused on the actual ratio analysis stuff, and then we can talk about that afterwards. So the financial strength ratios, as it suggests, are based on how financially strong is my company. And we look at the first two ratios, and I probably should have put this in the opposite order. I should have put the current ratio first instead of the quick ratio. These ratios specifically refer to the financial strength in terms of the company's liquidity. How liquid is my company? If I have current assets of $100 and I have current liabilities of $50, then what that suggests is that if I needed to, I could pay off my liabilities, my current liabilities, out of my current assets 2 times over. So that means I have a ratio of 2. And Dennis just posted in the chat a link to some PowerPoint slides that he used for a presentation on financial ratio analysis. Thanks, Dennis. So we want to know how financially strong our company is because we want to know if we ever needed to, would we be able to pay off our debts in the short term? And, to that end, again, these ratios by themselves are sort of meaningless on their own. They become meaningful when they're used on a comparative basis. So it's not so much that I'm able to pay my debts off twice over that matters as much as it matters, is that ratio improving over time? Right? So if it's 2.0 today, and that's really, let's say I started off my business and it was, 0.5. Let's say I couldn't even pay my liabilities off if I needed to in the beginning, because let's say I had to take on some debt in order to get my company started, which is very common and very normal. It doesn't mean, it's not a bad thing necessarily. But then that's when you really want to start monitoring that kind of thing month in and quarter in and out, and see, is that ratio improving? Am I getting from 0.5 to 1.0 eventually, and then from 1.0 to 1.25, and so on? And so what I've done with clients over the recent years is I've started to run these ratio analyses and provide it to the clients on a, sometimes weekly basis, depending on, sort of how big the client is, and how much of my own resources I'm able to put into it based on what my monthly fee is. And that's why we have packages with larger fees, because if clients want this kind of thing, or they want it more frequently, then they can go up to the next package, and then I'm happy to provide it. Because here's the key. If I run these analysis and just send them a report, it's going to be worthless to them. And the time I've spent is going to be worthless to me. The whole key to this is that I actually run this and then review it with the client and explain it to them, which means that we as bookkeeping and accounting professionals need to understand it well enough to be able to explain it. And this is exactly the point at which we start becoming that more strategic advisor that I believe everybody's talking about when they talk about becoming a firm of the future. Is we really need to get into this kind of analytic stuff and start measuring the progress that our clients make by analyzing their financials. right? You get the less experienced client who's printing checks still, you got to get them up to speed before you can do this. You know, we have to do the basic arithmetic before we can get into the trigonometry, right? So the first goal should be to get to the client to the place where you can really do this. But it's going to be worthless to the client unless you go through it with them and say, hey, client, I just ran this analysis. Last quarter over this quarter, your current and quick ratios improved dramatically. And I want to review that with you, and I want to explain to you what that actually means, why it's important, and then I want to make the case for us tracking this on a regular basis going forward. And I can almost guarantee you that if you go through that process with the client, bring the reports up and talk through it and look deeper. So if the ratio is improved, look at it from all sides. What happened? Did my assets increase? Did my liabilities decrease, or both? Right? And why? What did I do to make that happen? If I did something well, what did I do well? Right? I need to understand why it happened, not just that it did happen, because then I can leverage that. And I can say, hey, client, this is what you, and so let's say the answer is their revenues skyrocketed, right? And they also didn't take out all that money in distributions because, like Dennis was talking about, as S-Corps, for example, we don't want to take all our money out in distributions. It's a bad strategy on a number of levels, not just with the IRS, but it also sucks equity out of my company without getting a deduction for it. So, you know, for me, one of the strategies with my clients is I want to build the equity section of the balance sheet. You know, that's where I can really literally grow the value of my client's company, is by getting that equity number to increase quarter over quarter, year over year. Because if they ever want to sell that company, that's where the investors are going to be looking, because that's what they're buying. They're buying the value of that company.
It also doesn't do much for your Social Security in the future either if you're not putting anything in.
That's true, but the argument on the other side of that is that money's not going to be there for us anyway when the time comes, because the money is not being invested well.
That's probably true.
So that argument often doesn't work, even though it's valid. You know, but again, the strategy in the big picture is I want to grow the equity of the company. You know, I'm stumbling here because I'm trying to choose the right words on this. But the bottom line is, if I can get the client to understand this stuff, and it doesn't have to be that they have to understand it on a real deep level. They just need to understand generally what it means and how they got there and why, because then I can say to the client, okay, you ran some promotion. That promotion resulted in increased revenues, which hit the bottom line because your expenses didn't go up at the same time. And now that money has been retained because you didn't take it out in distributions. So I've increased equity. I've increased assets because ultimately that revenue turns into cash, right? So I've increased my revenue, which went to my assets in the form of cash, which also went to my equity because we close out our income to the equity section. So I've increased two sides of the balance sheet without touching the liabilities. That's how I increase my liquidity and my financial strength in a company. That's the kind of strategy we want to begin to employ with a client. And if I can explain that to a client in a way that they can understand, then the client's going to see tremendous value in this, and they're going to be willing to pay money for that service, more than what you're charging now. I can guarantee you. The trick is for you to get into it and understand it really deeply so that you can explain it to the client on a level that they can understand, because remember, they're not accounting professionals. They're not necessarily numbers people. I mean, some of them probably are, depending on who your clients are. But the bottom line is, this is the kind of stuff that we really want to start impressing upon our clients in terms of that strategic guidance that we want to give them. So we look at the current and the quick ratio, and let me move over to that tab. And hold on, because I got a bunch of stuff in between here. So if I go to my definitions tab, the current ratio. What does the current ratio mean? A liquidity ratio that measures the company's ability to pay short-term obligations, kind of like I just said. And here's the explanation. I'll just read it to you, and then we'll go over the calculation. And then we're just going to get into the difference between the current ratio and the quick ratio, because they're very similar. So the ratio is mainly used to give an idea of the company's ability to pay back its short-term debts. With its short-term debts, with its short-term assets, cash, inventory, receivables, obviously the higher the current ratio, the more capable the company is of paying its obligations. So we want this ratio to be high, and we want it to continually increase, ideally. A ratio under 1 suggests the company would be unable to settle its obligations if they came due at that point. And while this shows a company is not in good financial health, it doesn't necessarily mean it will go bankrupt, as there are many ways to access financing, but it's not necessarily a good sign. And again, it's really about understanding the reasoning behind it. If, as I just laid out earlier as an example, it's because we're a brand new company and we started off by incurring some debt in order to get the capital we needed to get started, then it makes sense that we'd have debt and less in terms of assets to be able to settle that debt, right? Because we took on debt and used it to buy some things. Right? In theory, at that point, we depending on what we bought, what we spent it on. If we spent it on fixed assets, then we increase the assets on our balance sheet at theoretically about the same amount that we've increased the liabilities. So then what happens is over time, as we earn profits and use those profits to pay off that debt, our assets continue to increase while the liabilities decrease, and now we're getting financially stronger. The current ratio can give a sense of the efficiency of a company's operating cycle or its ability to turn its products into cash, right? Companies that have trouble getting paid on their receivables, for example, or having long-term inventory turnover issues can run into liquidity problems. So now, and you can obviously read this on your own, and I will provide it to everybody that's been here if you're not signed up for Patreon. Obviously, I'm not here to sort of withhold information from you. But obviously, I think you do better to honestly pay the $25 for at least 1 month and go review the course, because that's where I go into this in much greater depth. And Carmen Manrique, for example, told me this week that she has gotten feedback from her own clients about the tremendous value that they've acknowledged that she's offering them, because she's used what I outlined in this course and specifically related it back to her clients, and they're loving it, apparently, from what she tells me. So what the quick ratio does is, the current ratio is, the formula is very simply your current assets divided by your current liabilities. And I've got it up there on my screen. Quick ratio simply excludes inventory from that mix. The theory is that inventory may not be liquid. If I'm stuck with a lot of inventory, I may not be able to liquidate it in the short term in order to turn it into cash and use that cash to settle my obligations. So some people feel that the quick ratio is a little better measure of the financial strength of my company in the short term. So anybody got any questions about any of this so far before I move on? Because I'm going to start sort of whipping through this a little faster now. Okay, and let's see.
I have a question.
Sure.
Is there a formula that would take the quick ratio and back out the 90-day receivables and greater?
I mean, sure, you could. I mean, you'd have to sort of do that manually. I don't know that there's any formula in Excel per se for that. But you'd have to, and we're going to get into some other ratios here that obviously deal with like receivables turnover. And in fact, there's a number of ways in my research that have been defined in terms of how to even calculate receivables turnover. Okay, so now let's look at the next one. Let's go back to, I want to do it kind of in the order in which I had laid it out here. So we did quick and current. So now we want to look at long-term debt to total equity. And if you think about it, if you really think about what even that ratio's description suggests, it should start to make sense in terms of what we're analyzing here. If I'm looking at equity, I'm looking at, again, the book value of my business. What's my business worth today? What's it worth at a moment in time? And looking at that, and so what does it tell me when I compare my long-term debt to that? Again, think in terms of the trends over a period of time. What do I want to do with equity? I want it to continually increase, right? What would I like to do with debt? I want my debt to continually decrease. I want debt off the books. Debt costs me money, right? Companies can be profitable, and yet they can go out of business due to poor cash flow because too many of their profits are needed to pay down the debt that they took on, right? And that's where debt can become really dangerous to have in a company, especially if you're highly leveraged, which means you have a lot of debt. So the idea here is over time, I want to see long-term debt decreased. I want to see my equity increased. So this is a ratio. When I take my debt and divide it by the equity, I want to see this ratio get lower and lower as time goes on. That suggests an improvement. So it's important to understand what represents an improvement on these. Quick and current ratios, I want them increasing, right? That represents an improvement in the financial strength of my company. Long-term debt to total equity a decrease represents improvement in that ratio. And what it means is that I'm using my resources wisely to get rid of the debt that I have. And when I'm comparing it to equity, what it means is equity, in effect, represents what I, as the owner, have invested into my business, or what I've, for that matter, retained based on the earnings, right? Because that's what equity really is. It's what I've contributed into the business, plus my cumulative earnings forever, minus whatever I've taken out of the business. And that equals the value of my business today. So the more equity I build, the more valuable my business. And if my debt, what it suggests is that I'm putting that investment, so that's what I want you to think of. The equity is as the business owner, your investment into your own business, or your client's investment into their own business. That's what the equity truly represents, right? Because not taking the earnings out, let's say in the form of distributions, is another way of reinvesting my profits into my business by leaving them in there, right? So I want to keep my profit. That's what retained earnings means. It's the earnings that I've retained, that I've kept in the company, that I haven't drawn out. So the more I can increase that, and the lower this particular ratio gets, the better it suggests that that investment is going to work for me. I'm putting my investment into my company to good use when I'm retaining those earnings and using those funds to settle the debt, to get rid of that debt, so that ultimately the perfect world, the nirvana state of a company would be to have no debt. Right? And to just be paying for everything out of its operating profits every year, every month, every week. Okay, so long-term debt just looks at the long-term piece, and then we have total debt to total equity. And of course, that's the same thing, but now we're looking at all the debt instead of just the long-term. And I think the distinction, and Dennis, I'd love to hear you chime in on this, long-term debt is considered more risky. Isn't that right? I always get this confused. If it's long-term, it's more risky because there's more time over which to pay it off, which means there's a greater risk that I might not be able to pay it off because I don't know what's going to happen in the future. Is that not the theory?
I would think that sounds logical to me. I think there's some risk with short-term in the sense the rates are probably higher and that you're kind of baking in fixed cost into your break-even analysis too with debt. And that's one big danger is that you're kind of reducing your flexibility, especially if you have to sign loan covenants and that kind of thing with banks. And so you're kind of reducing, the more debt you have, the less, freedom you have to run your business the way you want to. You're kind of restricted by both outsiders and also by baking in the fixed cost.
Right. Got it.
But Seth, sometimes long-term debt is from real estate. So, usually for property, you have a different type of balance sheet.
Well, and again, context is everything. So, it's not to say that just because you have debt, it's a terrible thing and you're going out of business. You just have to understand what's there and why and how it's being used.
Well, the leverage too. I mean, it's like...
Yeah. I mean, and again, real estate is a perfect example of what I just described, where if I've taken on too much debt because I've borrowed a lot of money to buy properties and my operating profits aren't sufficient to be retained after having to pay off all that debt, again, that can be very precarious for a company. Does that make sense?
I mean, generally they're going to want long-term debt, though. It looks better. Their ratios look better.
Well, yeah.
It's easier to pay bills.
I don't follow that, to be honest. Why would a ratio look better with more long-term debt? I would think if I own the properties outright, that would improve the financial health of my company.
Well, not necessarily property, just in general. Because a lot of times what the banks will do if you violate the covenants that are in your loan agreement, all that debt now becomes current. So now you owe all that money. And I'm not saying just for real estate. I'm just saying in general with debt.
Well, in terms of your current ratio, yeah, it looks better if you've got less.
Oh, I see what you mean. So you're saying you're better off having more of your debt classified as long-term versus short-term because of some of this analysis. And that I agree with 100%. But in the bigger picture, I still say it's best to try and get debt paid off as quickly as possible. That should be a strategy, I think, always, is to get debt paid off, whether it's long-term or current. But I get what you're saying is the more you can classify as long-term debt, the better your current ratios are going to look, no question, because you're excluding all of that debt from the picture.
Also, it depends what you're borrowing for. If you're investing in machinery and equipment to expand your warehouse or something versus if you're borrowing on inventory or AR.
Right, and that's the exact point I made earlier, which is that just having debt by itself isn't necessarily bad. What's important is understanding how that debt is being used and whether it's going to work for you. And that is exactly why we get to the, and sorry, my warning just came up about my next appointment. But that's exactly why we can't stop here and just look at these ratios alone. We have to look at the next section. When we get into management effectiveness, we start looking at return on assets and return on equity. Return on assets addresses, Laura, what you just brought up specifically, is how well are my assets being used to generate profits, right? So if I take on debt to invest in assets in my company, and those assets are generating a profit, then management has been effective all the way around, because we borrowed money to get something we couldn't have afforded otherwise, but then that money was used to invest in an asset which generates profits. Right? So that's why it's important not to stop at any point along the way here, but to look at the whole picture. The same logic behind why it's important not just to look at the balance sheet and the profit and loss, but you also have to look at the statement of cash flows. And so many of us ignore that. And in some respects, I would argue it's the most important one. So, that's the problem, is we can't stop short here. We have to look at the whole picture. I can't just look at current ratios and quick ratios. I have to look at, and again, and I said this before and I'll say it again because I think it's important, and I think Laura just underscored this really well, which is that, yes, by strict definition in the bigger picture, generally speaking, and I mean very generally speaking, it's better not to have debt if you can avoid it, but that doesn't mean that having debt is a bad thing. It's just based on how that debt is being put to use. If I incur that debt in exchange for the purchase of assets which are helping me generate profits, then I have a perfectly valid and good reason for having that debt. But now, having had it, again, what I would want as the CFO, what I want to employ as a strategy is to see what we can do to keep reducing debt while increasing assets, because that's going to overall make the balance sheet look as best as it can possibly be. And ultimately, the way to increase equity in a business is to increase assets and reduce liabilities, right?
I think Finagraph has, one of their analytics is the mismatch between assets and liabilities, where if you're funding long-term assets with short-term debt, you're in trouble. I mean, for example, look at the banks. Let's look at the banks in trouble.
Yep. And the banks look at this stuff. And Finagraph is actually covered in the course, because Finagraph, first, I think it's important to understand all this stuff. And then my last lesson on the financial ratio analysis actually shows you Finagraph and how Finagraph kind of simplifies all this for you and gives you a way to present it to your clients that's much easier to understand and much more visual. But let's talk, because I only have about 10 minutes left. I want to get through the rest of this. So, again, we're looking at debt to equity as a measure of financial strength. Again, over time, we want this to improve, but just to be 1,000% clear, this doesn't mean that having debt is bad. It just means that, having debt needs to be analyzed, and it needs to be understood whether or not and how that debt is being used to a good effect, right? Then we get to the management effectiveness. How effective is management? Management might be just the owner of the company who's your client. How effective are they at investing money into the assets, right? When we look at the statement of cash flows, the investing activities section essentially is what we spent on fixed assets, right? And so because that's us investing money into our business, and presumably when we buy assets in our business, it is for the purpose, the intention is for those assets to help us generate revenue. So if I buy machinery and equipment for my business, I'm hoping that machinery and equipment is going to help me produce some product which I can then sell at a profit, right? And if I had to borrow money to pay for that machinery and equipment, that's good, right? But again, now that I've borrowed the money to pay for that machinery and equipment, I better make sure that I'm generating enough of a profit to cover all my operating expenses and eventually pay down that debt. So that at some point in the future, what I should wind up with is the liability should disappear, and I should still have the asset on my books. The asset then gets depreciated over time. And then I wind up with machinery and equipment that's generating pure profit. As time goes on, assuming I don't have to replace that machinery or spend too much fixing it too often, right? And so when we start to analyze those kinds of ratios like return on assets, and return on assets, as it suggests, is we take the net income divided by the assets over a period. And we compare that one period to the next. Are we getting a better return on assets over time, or is it decreasing over time? And what this can lead you to, and you'll see this explained in Finagraph when you go through these ratios. One of the reasons I love Finagraph, by the way, separate and apart from all the others, is in addition to giving you the calculations, as you move your mouse over things, Finagraph is free, and it will actually give you the definitions and explanations of these ratios. So you can hover your mouse over return on assets, and it will explain to you, it will analyze your own data, it will tell you if your return on assets looks bad and what can be done about it, right? So it gives you a lot of the strategic guidance that you want to be able to turn around and give to your clients on this. But and most specifically here, what I want to point out is that it might be, if our return on assets is decreasing over time, what that could suggest is that it may be time to get rid of some of those assets, write them off. Right? And if we can justify doing that from a tax standpoint, then that's going to improve that ratio. And what it really suggests is maybe that asset really isn't doing its job well, right? And maybe it's time to replace it or get rid of it, get something new, get something that's more efficient, right? Again, this is how this stuff needs to be analyzed. The other part of management effectiveness is, again, how well are they managing their own investment into their company, right? So again, we look at net income divided by the equity for a given period and compared to another period. And we say, is our return on equity increasing or decreasing? How well is management managing the investment into the business, especially if I have outside investors who've bought into the business, not loaned money to the business, but who've actually invested in the business. Again, that shows up in the equity section of my balance sheet. So I want to analyze how well is that investment being managed, right? And return on equity gives me a sense of that. So I look at return on equity, again, on a comparative basis over time to see, is it improving or isn't it? So then we get into the profitability ratios, which much like the growth rates, it becomes much more straightforward again. We're all familiar with gross profit margin. And you all know how to analyze it, right? We take our gross profit divided by our revenues to come up with the gross profit margin, and we want to see that increasing. And a lot of times we're trained to compare this to quote-unquote industry standards. And with Finagraph, for example, you can put in your NAICS codes to get the industry standards and get that compared with your company in your industry. But here's why I don't love that approach. Because I really don't have a good sense of what that's truly being compared to and how comparable it really is. I don't know how many businesses are really being thrown into that NAICS code and whether or not it represents a true comparison. And in the bigger picture, rather than comparing myself to the industry, I would rather just compare myself to myself over time. I would rather just look at this quarter versus last quarter and this year versus last year and make sure that I'm improving. Because if I can pursue that goal, and I keep improving over my own performance year over year, quarter over quarter, then I don't care what the industry standard is. Eventually, I'm going to surpass it anyway, as long as I maintain those trends, right? So I compare it to the swimmer swimming in a race, and I say to myself, if I stop and look at what the person in the lane next to me is doing, I just lost the race. Because that little bit, that second in time in a swimming race will cost me the race almost always. And so I'd rather look at myself in comparison to myself. To me, that's the best benchmark I could ever use. So we look at profitability and we look at the gross profit margin. And again, we compare that month over month, quarter over quarter, year over year. Is it improving or isn't it? And the important thing is to understand that if we feel it's not improving or it's getting worse, why and what can be done about it? Because if we don't have the solution, just identifying the problem is only half the battle, right? And the other important thing is to identify what we've done well. If I've done something really well, I need to understand what I did that made it work well so that I can make sure that we keep doing that or do more of that. Or maybe there's a way, once we identify what we did that worked well, that we can, again, exploit that and expand and enlarge upon it. So we look at our gross profitability, our gross profit margin. We look at earnings before interest, taxes, depreciation, and amortization. And we look at that as a percent margin. And the reason we do that is a lot of investors, when they're looking at companies and deciding whether or not to invest in them, for that matter, when a bank is deciding whether or not to loan money to a company, they want to pull interest, taxes, and depreciation and amortization out of the equation. And they want to see, what does the company's true operations look like without all that stuff? Because to some people, that is a better measure of how the company functions on its own. The interest represents debt that had to be taken on in order to finance the operations of the business, presumably. So can the company function on its own without all that stuff? Again, it's one measure. It doesn't mean that you shouldn't have interest, taxes, depreciation, or amortization. It just means that it's another way of looking at the kind of raw data. How does this company truly function? Is it effective? Are we ultimately going back to the statement of cash flows? Are our cash flows substantially coming from operations, or are they coming from investing activities because we keep having to pour our own money into the business to keep it alive? That is a really important measure of how well a business is doing.
I always say that if you look at the cash flow statement, if you don't have a positive cash flow from operations, you don't have a successful company.
Exactly. Now, that doesn't mean that you should close the doors. It means that you got to take a look at that and see if and how you can turn that around, right?
Yeah, I mean, you're building fixed costs, or you're basically your product. You're either taking money out of your pocket or you are borrowing money to keep the cash going.
Exactly. So you're either borrowing money to keep the company going, or you're taking money out of your pocket. And in either case, you can only sustain that for so long before you will have to close the doors. So eventually, and at a certain point, you have to see that the cash flows are coming from operations. And the goal ultimately should be to make sure that at some point you can run the company entirely from its operating cash flow and not have to ever depend on borrowing money. Ideally, it doesn't mean it should never happen. But in a perfect world, I could I could run my business without ever having to borrow money and without ever having to invest any more money in it, because hopefully it's generating enough of a profit on its own. And I want to be careful to qualify that by saying that doesn't mean I should never borrow money, because I may have an opportunity and I don't want to exhaust my cash in the acquisition of an asset, right? Because I need cash for working capital. So sometimes it makes more sense to borrow the money to finance the activities of the company, right? And so I use that to, to get an asset on the books. And keep in mind, ratio-wise, if I borrow $100,000 and I use that to acquire a $100,000 asset, that has no impact on my ratios, right? Because, again, if the debt is long-term and the asset is current, then it'll impact my current ratios. But the overall balance sheet doesn't change at all, because I've increased the liability and I've increased an asset by the exact same amount. And what's going to happen next is we're going to depreciate that asset, right? But then we're also going to be paying off the liability. So another strategy would be to say we want to make sure that we pay off the liability at least the same rate at which the asset's going to be depreciated, if we can, because that way we maintain the ratios properly. Right? And it also keeps us financially healthy. Because if I let's say I do Section 179, write off the whole asset in the first year, I've just destroyed my ratios, because now I have zero value in the asset, right? And I still have that big liability on the books that I'm carrying, which is going to bear interest expense. So this is the kind of stuff, and I hope that as you're listening to this, you can sort of take a step back from everything I'm saying and kind of just take a breath and absorb it, because I know it's a lot to take in. But just kind of slow down and look at this from the big picture. It doesn't mean you have to understand all of this in great depth all right now. What it means is that you want to start to take the time to think about this stuff and start to gain an understanding of what it all means and how it really can impact your client's business, and how providing this kind of analysis and doing the comparative analysis and sitting down with your client and explaining it all to them can add tremendous value to the service that you offer to your clients. And with that, it's 3 minutes after 9, so I'll stop and I'll see if there's any more questions, comments, feedback, concerns. Anybody need therapy?
Don't we all need therapy?
I think we do, because we're all
Seth, that was an awesome presentation.
Thank you. Thank you. A lot of people were dropping off. I felt like I was maybe losing people. Maybe they just had to be somewhere.
Could be. It is Friday a.m. Got to wrap up the week.
Absolutely, without a doubt. It's a good time to start doing some ratio analysis.
That's my homework.
All right. Well, I of course sincerely hope that you all got something valuable out of this, and I know it's a lot to absorb. Which is why I did a whole course on it, so that you can go through and absorb it at whatever rate is comfortable, right? So I basically tried to pack an entire course into the hour and didn't even get to the valuation part. But the valuation part's pretty simple. Just take what you want somebody to invest and the percentage of ownership you're willing to give away in exchange for that, and do the division. You divide the investment amount by the percentage and you get the gross valuation of the company. And that's what the sharks do on the Shark Tank. When you watch that show, the first minute that the contestants come on and they say, I would like $500,000 in exchange for 50% of my company, that means they've valued their company at $1 million. 500,000 divided by 50% is 1 million. Right?
Yep.
Somebody put that on a spreadsheet and check my math. So, all right. Anyway, I'll get the recording for this up hopefully tomorrow at some point so you can all review it. And like I said, pay the $25, take the course. I go through it with you, and you can go through it at your own pace for those of you who aren't already in there and on it. And for those of you who are, I appreciate it.
Well, thank you.
Thank you. And Gina, what's going on later today? I can't hear you. Unmute.
I had to answer my phone. I answered it and hung up. Sage Payment Solutions. We're going to have a demo about Sage Payment Solutions that works with both Sage and QuickBooks, and actually Xero too. So should be pretty interesting.
Very nice. And Dwayne asked a question I just caught in the chat, so I'm going to answer that question and then we'll go. So do I compare my client competition in my presentation? And The answer is I don't. It goes back to my whole swimming in the lane comparison, but there's definitely value in that, especially if you have a lot of clients in the same industry. And there's a great tool out there that will help you do this, which is QVinci. If you use QVinci, you could set up locations for each of your clients. Your clients don't need to know about this. You're not going to share it with them. But then you can use that to create benchmarks based on your clients, and you can even divide it up geographically. And you can use that to produce an analysis that won't reveal who the clients are, but that you could then present to your clients and say, here's how you fare against your competition. And I know whom exactly. It's not like a NAICS code. I know exactly whom I'm comparing you with. And these are all companies in similar industries in the same area that I'm comparing you to. And the chat does get saved. I usually never provide it because I never think to, but anytime you want a chat transcript from one of these, just let me know and I'll email it to you or make it available somehow otherwise. Because Dennis rather posted a lot of really good links in this one for resources on ratio analysis. So, you know, by all means, take advantage of that. I really think if you want to spend time learning how to become a firm of the future, I think this is the area that would be the most valuable for you to get into learning. And I'm not just saying that because I have a course on it. I'm saying that because I think this is where you can add the most value for your clients in terms of becoming that strategic advisor. I think this is specifically how you can do that. You know, whereas everything else is just chatter. It's just talk. Like, let's stop talking. Let's get into action. Let's do this. And with that, I'm going to bid you all a great weekend and enjoy Gina's hangout later on today.